Greetings, Jonathan. Camarda, as we move towards a mid-month market update. Did want to kind of start with where the market is right now, kind of give you from a sector standpoint what we're looking at, as well as some of the strategies, overall positioning, and then break down the yield craziness from last week. Give a little clarity to what really happened. Okay, so let's start at the top. So the market, after having a pretty tumultuous drop and then some change in news last week on, some of the tariff talk, market came with a vicious rally. Now, in bear markets, we do see these vicious rallies to the upside. And right now, the market is conveniently stuck right at that 50%, what they call retrace from the top to the bottom, about a 50% retrace. Pretty heavy resistance there. Even if it is a self-fulfilling prophecy by institutions, which are very strong, as the market is below major moving averages that we covered last time. And so there is a lot of cement in that ceiling right now. Now, we shall see. We have seen a repivoting over the last week or so with technologies and discretionaries really bouncing hard off of very oversold levels. Still, your best performers year to date and over the last few months have been your consumer staples, your utilities, and as such there. Energy, of course, the price of oil going down, and energy has been your worst performer recently. But year to date, still, over the last few months, technology is discretionary, still down there as well with energy as real estate's come down. So we are still in a defensive market is what that means. When we look at the S&P 500 or equities versus bonds, underperforming, even with the little recent spike, and gold still outperforming both bonds and equities. So that's a defensive posture. And so in your strategies, you'll notice that is what has taken place. So if you look in your macro momentums, that has essentially transitioned to active capital preservation after the market drops below a certain level, which is a conservative strategy that has done well year to date. Won't perform as well in the bounces, but certainly an insulator when we do, if we do reside to the downside. Sector momentum, which did really well, going 50% out earlier on a few weeks ago, and then eventually all right now to your Schwab money market, and so that's comfortably positioned pretty well versus the market in that position. Now, some of the strategies that are being more tactical, surfing, if you will, at dusk with dorsal fins about, Velocity Raptor, Global Macro, especially for some of my clients and then some of the Camarda clients as well, has done very well. Attractive stocks, some shorts, some money markets in there, and those have held up well versus the market the last few weeks. And then All Stars, more across the board for everyone as well, which has some short NASDAQ and some opportunistic long positions with some money market as well, has done well, again, with the vacillating condition. Now, the National Association of Investment Managers, which we always sometimes look at their positioning, they've come down from the low 70s to about 57% exposure to equities right now. And if you look across your sleeves, a lot of your clients, if you're moderate aggressive, you're right about in that same range with the strategy positioning. Not that we follow them, but great minds. These are the institutional minds, not your typical financial advisor, which we are not in that regard. Now, another strategy I'm going to get to, opportunistic growth and income, which is doing well versus the markets as well. That has stayed fully invested, however, has performed pretty well just due to pretty good stock selection that has caused during the spike for some performance alpha makeup versus the markets. Now, that could start to take some money off the table if things really progress to the downside, but yet to be determined from that standpoint. The last thing that I did want to go over as well is the whole Treasury spike last week, bonds coming down. A lot of conjecture are other countries selling our treasuries. Not really sure where they're going to go. Are they going to invest in the yuan? But there might have been some selling. But really the culprit was what they call the basis trade for large hedge funds. Your Citadels, your .72s. I mean, Steve Cohen stole my Juan Soto from the Yankees, so not really a big fan of his these days. Your Millenniums and as such, these trade billions in regulatory assets, treasuries, okay? So the way the basis trade works is they make money on small spreads and what they call reversion to the means, a lot of money on a lot of small profit trades by buying treasury bonds, and then what they do is they short the treasury futures, and again they collateralize with the bonds they bought with the leverage of selling these futures short, and they usually go about 20 times, people. So what ended up happening is if we did have some sales of treasuries out there internationally, okay, drove the prices of the bonds down, that caused what their collateral asset to come down, forcing margin calls okay, margin calls that caused them to have to sell their treasury bonds to cover their shorts, and what happened? Rates spiked. So again, there might have been some foreign selling. We really don't know the details, but the major ripple that you saw in rates, when we're looking at the 10-year, for example, they got up to 4.5 again from 4, was caused by the hedge fund poker games being called back in the garage, right? The police showed up and as such, and the poker games were, the tables were turned over. That's what really happened with rates, just in case you were wondering. You're not really hearing that as much on the news and as such, but in the institutional knowing what's happening think tanks, that is exactly what happened last week and as such. And this played out back in 2019 and 2020 during the COVID, the dash for cash. And though there is some seriousness to it, though, as we look at credit spreads widening, okay, between quality and your more junkier bonds, not at serious levels yet, but it is increasing. And then in the past, the treasuries had to come in, and I think they will, to purchase treasuries if this does continue, because regardless of what their feeling on inflation is, they do need to reserve the integrity of those markets. All right, so what that says, well, right now, we have a Garmin, right? We have a Garmin, yes. We got a Garmin, we got a miner's helmet, and we are on a 360 Lazy Susan, looking at every aspect. And if you have any questions on your strategy selection, your risk appetite, if your situation's changed, of course, your personal wealth advisors during your quarterly calls. My clients, again, we revised and reviewed this coming in with the active strategies taking place the way they do to take into account where the market topography takes us. Till next time, that was kind of a quick one, but a lot of work to do. Jonathan Camarda signing out. Pleasure to serve.